Okay, I think we're going. We're live. Here we go. Perfect. Now you'd think I would know how to turn the music off, but I don't, so... Here we go. Okay, excellent. Hello, Matt. Can you hear me okay?
Hi, Bill. How are you?
Good, I'm doing great. Hello, everybody. Welcome to our, I don't even have a name for this. It's like Sunday with Bill, whatever you want to call the show. Excellent. Well, welcome to Startup Funding. Today we're going to be talking about startup funding. I have Matt Schaubroeck here with me, CEO of ioAirFlow. How you doing, Matt?
I'm doing great. It's happy to be here for this topic. Timely and always something at the front of mind. That's
perfect. Yeah, it's great. It's great having you. I'm glad you could join me again for this. So just a couple of public service announcements. We have a chat. There is a chat going. There are a couple of people talking in the chat, which is great. If you have questions and you're watching this and you're here live with us, ask questions in the chat because I can see those today, unlike in past live streams, and I will be trying to answer your questions and Matt also. So subscribe to my channel. This is not my main YouTube channel. My main YouTube channel is The Company's Expert. Link in description. This is The Company's Expert Live, just for live streams. And once again, another shout out to all the people who join me on Facebook. I've got two Facebook groups. The Company's Expert Entrepreneur Success. There's like 90 people in that. And The Company's Expert Get Hired, where there's about 110 people in that. So thank you very much. It's great to see some of those people here. Okay, so here we go. So startup funding. Matt and I both have some experience in this, although I believe different experience in this. And Matt, being the CEO of a startup company here in Winnipeg, Canada, you've had a lot of experiences. You've been on the front end of this and where the rubber hits the road for a few years, as I understand.
Yeah, well, and I think, Bill, our experience takes us down very different business models. So I've been trying for about 3 years to run a business that was pre-revenue, and we're now just getting into the market, but had to survive for 3 years off of grants and loans and throwing my own money in, and the creativity required to take care of some of those financing solutions has been eye-opening, to say the least. We've had a chance to really kind of get to know the landscape here in Canada and, of course, locally here in Winnipeg as well, quite intimately. And I'm sure there's a couple funding agencies that are sick of seeing my email pop up in their inbox.
Oh, yeah, well, that's how it goes sometimes, right? No, that's great. Yeah, you've had an opportunity to explore a lot of the different sort of government funding, right? I mean, when you talk about this topic, it's a huge topic. There's the sources set up for entrepreneurs by the different levels of government. There's also sources set up by private institutions, like a lot of universities and stuff have their own programs to do grants or loans type financing. And then there's the more traditional startup type funding, which would be, basically investors at different levels, different classes of investors, right? Where you're dealing all the way from angel investors at the low end up to VCs, probably at the high end. And this topic might even include acquisitions, like getting acquired by somebody. That's on the sort of high end. And there's IPOs and all that kind of stuff. So to try and limit this, what do you think would be a good place to start, really, to get into the weeds on this one?
Yeah, well, I think it's important to start at the starting line, which may sound a little weird, but I think that this is a pretty common mistake that first-time founders might make is they start with a plan and they think, okay, well, I can get 200 grand from all these different sources, so I might as well get it all. I'm not sure what I'm going to do with that money yet, but let's start here and then we'll figure it out as we go. And my suggestion is that it probably makes a little more sense to take the time and figure out what you're going to do with that money and to make sure you're getting it from the right place. So there's a lot of times when as founders we get access to some capital. Maybe we're going to get an investor at a very early stage. Maybe there's some debt solution out there where there's a bank loan with a nice interest rate. But take some caution in those decision makings. Just because the money's there, it doesn't mean that it is necessarily the best choice for you and your company to take on right away. And I mean, we can talk about that a fair bit, but at the core, really understanding what your plan is to get into the market and then scale up from there. And then think about really what costs you need and then go out and find money for those costs. If you went out and tried to raise $2 million, but only needed 100,000 of it, I mean, first of all, that's going to be a hard sell to investors. And second of all, you've just worked for months trying to get this $1 million when you could have been actually going out and trying to sell something instead. So there's a trade-off there. And I think a lot of founders, they come in with an idea and say, this is great. I'm going to go talk to entrepreneurs. That may not be the right solution.
Yeah, I mean, you're right. Like even before you start, there's different schools of thought on this. And you mentioned raising like, $1 million, $2 million, this kind of thing. That is done in certain circles. That's kind of a normal operating procedure. If you're in Silicon Valley and you're doing a tech startup or a highly innovative startup, that's kind of their culture and how they do that stuff. They're on the other extreme. There's others that say, and I've seen, celebrities on YouTube videos, celebrity entrepreneurs and CEOs saying, don't start a business with debt financing. Don't take out a loan and then do something extremely risky. And that kind of ties in with my background, which is, like I have a master's degree in finance. And that's kind of the conventional wisdom, is that if you're doing something risky, don't leverage yourself way up like that to do it. So there's different ways of looking at it. And then that maybe the third sort of thing, sort of somewhere in the middle, is doing a traditional business. You want to start a construction company or something. It's not innovative. They're not going out and raising $2 million of seed capital to start a plumbing company. So they may go to banks and things like this and do some debt, but a lot of it is either going to be angels or it's going to be their personal savings. So, I mean, what's your opinion on this? I mean, would you advocate taking, like, when you first want to start, focusing all your efforts or most of your efforts on raising debt financing or equity financing? Are you in that kind of school of thought that that's kind of the way to go?
Yeah, I mean, it really depends on the business, I think. And I should say at the beginning, I guess my little asterisk for the day is that a lot of investors tell me that I'm too conservative, that when I go and try to raise rounds, I should be asking for more. There's no right or wrong answer on this. So any of the things that we'll be talking about, you'll probably find 3 different people giving you 5 different opinions. So it's important to figure out what works for your business. But for me, because what I'm building is software as a service, and there was a fair amount of R&D that had to go into it before we could build something that made sense to go to the market. So we couldn't use revenue. And because it was still in the early stages and we had to test stuff, it just wasn't necessarily favorable for investors to come on board at that stage, especially here in Winnipeg, where there's the investor community, A, isn't very big, and B, isn't necessarily incredibly tech savvy. So trying to sell this business model to someone who's more used to traditional business models is tough. So we didn't have much of a choice. We had to go debt financing and grants. The grant landscape is great here, but you're getting 50 to maybe, if you're lucky, 70% of your costs covered. Sometimes it's even less, but you still have to find that matching amount, and it has to be private money. So if you don't have an investor and you don't have a fat savings account, there's not much other choice. And so it's risk management. Like everything with an early stage startup, everything's about managing the risk and making sure that you're not putting yourself into a very negative spot later on.
Yeah, and I think that's a great point, because I think a lot of people can relate to that. You don't happen to be located in the bright center of either one industry or the bright center of where a lot of the financing options are. Like, that's one of the reasons why people go to Silicon Valley, is not because necessarily the technology is there or the operational type resources are there or because the talent is there. It's because the lenders are there, the investors are there, and that everyone comes to them. But that is, I would say, a minority of startup and entrepreneurial ventures. They're not all going to pick up and move to either another country or to, you know, across their country necessarily to start something. So that's kind of the thing. So finding yourself in a certain business environment, you have to respond to that business environment. And the other thing you said that I want to pick up on was, you were saying because of the nature of your business idea, it required a lot of R&D and a lot of operations type stuff, developing a product up front. So for that reason, if I understand correctly, that's the driving factor why you advocate, like, okay, you need to put your financing up front and focus on that first. Would that be a fair statement?
Yeah, I mean, for us, we took a look and thought, you know, it's going to cost us about $150,000, give or take, to build something that's market ready. So where are we going to find that money? And if the worst case scenario, because you always should be planning for the worst case scenario when you make these kinds of decisions. Worst case scenario, when we default on all these loans, what's going to happen? And are we comfortable taking these risks and everything else? Which is where right now, this risk management, you really have to look at these deals. And debt obviously isn't the only answer, but just to focus on that for a sec. There are some great loan opportunities out there. Some of them are program-based. There's different agencies that can provide some favorable funding solutions, or just going to your bank or credit union. There's options out there that might make more sense. Credit cards typically don't. You can probably get a credit card with a nice big fat credit limit. That will cripple you, and don't do that. Don't do that ever. And there are a lot of startups that have financed on the backs of credit cards, and you read about them in books and articles, and you think, boy, if they can do it, so can I. What you don't see is they're 1 in 1,000 at best, and the other 999 are probably still paying interest on those credit cards.
Yeah, that's a great point. I can tell you from the financial perspective, I mean, what's happening there is that if you take out money on a credit card, you're borrowing money from a credit card. Now that money is at a very high interest rate. It could be they do all kinds of funky ways of calculating it. They compound it like every day, you know, things like this instead of every year or every month. Usually what people do is they do a conversion. So you convert the interest rate to its annual equivalent. Okay, so instead of compounding it every day, you just figure out how much interest you would generate over the course of a year. So say you generated 25% interest over the course of the year, that would be taking a loan at 25% interest. And that's usually in line with what credit cards do. And so what that means now is that your business has to be more than 25% profitable. Because if you made 25 cents on every dollar that you put into the business, you would just break even for your credit card debt, and you wouldn't be able to pay it off, right? You would just pay off the interest. So you would have to make more than that, which is pretty tough. So what you're doing is you're raising the bar quite a bit for how profitable you have to be successful, right? That's kind of the rub. So I see someone in the chat says, are there any types of funding that should be avoided? Do you want to take that one, Matt? I'd say anything with like really high interest rate. In your experience, has there been any red flags with things?
I would say the two red flags are interest rate and then the terms, as you say, as all part of that. So how often those are being charged, but also your payback period. So if you have something that there's no capital or principal payment required in the first year, and then afterwards you have a 5-year payback period, you need to look at that from a cash flow perspective, right? And understand that, okay, this is great for year one, but I better be making money by the time I have to start my principal repayments, or else this is going to get really expensive really quick. And I'm glad you brought up math concepts, because this is a great time to talk about the time value of money before we lose everyone. But just, and not to get into the equation of it, but just everyone needs to keep in mind that a dollar today is not worth a dollar next year. A dollar next year could be worth 95 cents today or something, depending on the interest rate. So if you're taking all your money on this big fancy credit card, not only are you paying interest, but that's money essentially that you're throwing away if you don't need it right now. Yep. So if you have money in the bank that you're not using, you're essentially, the value of that money is going down over time. So red flag that as well. If someone comes up and says, here's $100,000, but you have to repay me over 5 years, but you only need $20,000 right now, that $80,000 is going to cost you. And that would definitely be a red flag to look for.
Yeah, that's the nature of it. The other thing that needs to be said about debt is that the nature of debt is that, you borrow money to do a startup. Now, if the startup fails, you still have to pay back the money you borrowed, right? So you assume all the risk. Debt amplifies risk, right? Now, it's a completely different thing to equity, right? Equity is where, you almost have a partner. The investor says, I believe in your idea, and I believe in it so much that I'm going to risk my own money on your venture. So if the investor pitches in a bunch of money to do this business idea and the business idea fails, you don't have to pay back the investor. The investor has lost their money, right, when the business idea failed. So that's the difference. So the thing about debt is that debt amplifies your risk. It leverages you and it multiplies the risk that you're taking. Whereas the person loaning you money, the nature of the agreement is that you're going to pay that money back whether or not your startup idea succeeds or fails, right? So this is a very important, very basic distinction that I think a lot of people don't understand when they go into this. So a bank wants to loan them some money, or a lender wants to loan them some money, and they think, oh, great, they believe in me, and I got all this money, which is great. But like you said, I mean, the time value of money and the risk element here, it means that they don't really believe in you. They're expecting you to pay them back no matter what happens. So it's a very negative, it has a lot of negative effects on the back end that people, I feel, generally speaking, people should be more aware of before they jump into it. But that's not the case with grants. You mentioned grants, right? Would you like to talk about grants?
Sure. So we're in Canada, so I'll talk a bit about that ecosystem here. And there are some really, really good opportunities if you know where to look. If you're investing in something that's innovation or research and development, there are a ton of opportunities out there. That's category 1 of grants. And category 2 is wage salary reimbursements or cost sharing, or if you want to hire a co-op student for a term, which, by the way, is a great idea. If you're just starting off and you're trying to stretch your dollars as far as you can, hiring a recent grad or new students and then having maybe 50% of their salary paid for is, I mean, some of the best bargain money that you can get for talent. So it's all important about knowing where to look. So co-op and salary, it makes pretty self-explanatory. Look for the industry that you're in. If you're looking to hire someone in tech, if you're looking to hire someone in clean tech and software development, if you're working in bio or life sciences, there are an incredible number of opportunities out there. And if anyone wants to know more about them, you can email me, matt@ioairflow.com, and I can send you a list. The other side, though, the innovation grants. So again, we're very lucky in Canada to have access to the type of investments that we do. And there's some government-run programs, and there's some that are government-funded but private-run. And typically what you have to show there is that you're pushing the envelope, that you're building something new. And it doesn't have to be, this trailblazing thing new, but it has to be something that hasn't been done before. And so you've probably heard of programs like National Research Council, their IRAP, or Industrial Research Assistance Program. They have lots of solutions out there. They're active in every area in Canada with a federal mandate. There's also partnerships with research institutions and universities and colleges. I've been lucky to have a few of those myself. And the big one in Canada that everyone should know about, not many people do, is called SHRED, which is the strategic, I shouldn't have started trying to spell it, Strategic Research and Economic Development Tax Credit.
Yeah, it's the tax credit thing, yeah.
Yeah. And what that gives you, if you're doing any kind of innovative work, for every dollar that you put in, you can get up to, I believe it's 40 cents back, and then most provinces has a top up. So here in Manitoba, we get 55% of our SHRED eligible expenses back. So anything that's going towards research and development on something new, you get that money back cash in hand at the end of your fiscal year. And you got to jump through some hoops. I mean, it is the CRA, and they have a lot of forms with a lot of numbers and lines in it. But it's one of the best programs out there for entrepreneurs, especially those in the innovation space. Yeah,
and most countries have their equivalent of these entities, right? You're going to have some kind of federal level research type grants. Usually they partner with universities, things like this, and to help encourage people to turn their discoveries or ideas into something that creates economic development. So you have those, and then all the equivalent of SHRED would be like government mandated tax credits for doing certain types of work, like, you know, doing research into things, doing innovative type ventures. You can, if you're employing students and, you know, this kind of stuff, you apply for these and they will give you a tax credit. It's not quite the same thing as a loan. I mean, they just don't take as much money from you when it comes time for tax, right? So it's not quite the same thing as giving you money to start your business, really, right? I mean, I haven't had firsthand experience with SHRED as an entrepreneur. I've dealt with it when I was working in a company many years ago, but I know a lot of entrepreneurs here. You know, they're focused on that and they apply for that. You've done SHRED, right, for ioAirFlow? That's been a part of what you've done.
Yeah. And as a pre-revenue startup, let me tell you, when the checks aren't coming through the door very often, and then you get a nice check from the CRA at the end of your fiscal year, it's good. Nice.
Yeah. Okay, so still a resource. My kind of thing was you have to strike a balance, because applying for loans, grants, government programs, tax credits, I mean, that stuff is very time consuming. For most people, a lot of the time consuming part is discovering that they exist and then learning how they work and then doing the application process, right? I mean, if you've been in this game for many years and you're on the inside of this stuff, you know how these programs work, you have a bit of an advantage. But for most people, it seems like they have to spend their time educating themselves about these programs, and that sucks up a ton of your time if you're the CEO of a startup.
It does, and I should say there are people that you can hire to do your grant writing for you, and that, depending on your time commitments, might be a decent investment. I mean, nothing's ever guaranteed in life, but time is money after all. But if you're thinking of doing a lot of grant applications, what I have is essentially a template of all the different questions that typically show up in a grant application, and there's a lot of copy and pasting that happens just for the core stuff, and then you just go and tweak. But that saves an enormous amount of time. But you're right, Bill. I mean, it takes hours to fill in each grant because everyone's different, and you have to make sure that your application, the language you're using, matches the application requests and requirements and everything else. And you need to be meticulous.
Yeah, and that's part of a larger issue. That's part of a larger issue too. That, okay, we're talking about grants and government programs and things like that, but this equally applies to people that are going after angels and possibly even VCs or other, you know, sources of financing, is that this has become a full-time job for, in most cases, the CEO of companies. That becomes their entire job. They obtain financing. That's their role. That they should change their title to, I'm the person that I spend my entire day, every day, trying to get financing, and then I'm completely out of touch with operations and marketing and all the other things that have to be going on, because it sucks up so much of your time. And that's been a dilemma. Someone in the chat says, I just want to say, I think I made a major technical glitch or YouTube screwed up or something. And the live stream that I've promoted with the thumbnail and everything, this is not going out as that. So we had a bunch of people in the chat and they all left as soon as this thing launched. So there's one person that's asking questions now. They say, how can a regular Joe find an investor? Where would you even start? That's a great question.
This is a great question.
What would you say to that?
You have to put yourself out there, and networking is your best option. If you're looking at the angel level for an investor, there are a lot of people in cities, you call them like high net worth individuals. They have money. They're looking to maybe put that money into a company, but it's not like they have a website advertising it necessarily. You need to go find them and build that relationship. Especially at an angel level, what they're typically investing in is their belief in you as a person. So they need to believe in the idea, but they also need to believe that you are the person who's going to take it over the finish line. So go to events, networking, anything at all that you think that there might be some potential investors at, go and work the room. It's cheap to print off some business cards. I know in the 21st century it seems archaic, but you put that phone number in someone's hand, you get their number back, and you follow up with them, and you do it over and over and over. And then you do that with a second and a third and a fourth and a fifth person. You probably could be talking to 100 people every time you're trying to raise money, and you'll get 95 no's and 4 maybes, and finally you'll get a yes. So hustle is really the best thing that you can do in that.
And you learn by doing it. You learn by doing it, as I understand. I mean, as I recall from that stuff.
Mm-hmm.
Yeah, great. Okay, great things. First. Sorry, I don't mean to interrupt you, because whenever I talk, you get muted for some reason. So I'm just going to let you finish.
I was going to say, if you're not comfortable with talking to people and networking, the only way that you're going to get over that fear is by going out and doing it. And there will be times, perhaps, where you're going to mess something up, and that's okay. Just pick yourself up, dust yourself off, and go talk to the next person. It is the only way to learn the comfort there. Yeah,
and that's great advice. I mean, you said something like 3 things that I wanted to expand on because I thought they were great. Number 1, business cards. Yes, business cards. Go to vistaprint.com, print up some business cards for $20 or $15 or whatever it is. You can print up some professional cards. And you're right, it does sound archaic, but it is not. It is very, very necessary, especially to do this type of activity that you're describing where you're networking. You need to be able to get your business card into people's hands. They have your contact information. It doesn't just say your phone number and your name. It says what you do. It says your tagline, starting up this business. Here's my information. You could even put in like what you're looking for or some other little blurb of information about what you're doing. And then they have that. Then the type of activity you're describing, it's basically networking. Angel investors, for those who don't know, are, like you said, high net worth individual. They're people that they're investing their own money. And in practice, as you said, high net worth individuals, a lot of doctors I know will do that. They tend to be people that invest in things where they themselves are not a driving force in the business. They just sort of, like you said, they believe in you. You might be starting a company that's doing plumbing or something, and they say, no, I believe in you. I think you're going to be successful. And I think this city needs plumbers or something, a new plumbing company. So they will invest in you, whereas they themselves don't know much about plumbing, and they're not going to be sitting in on your meetings and, giving you notes and sort of standing over your shoulder. So they generally are those type of investors. I don't know any doctors that invest in like medical device type companies. You would think more of them would, but maybe they do. I just don't. I don't know any. I don't know if you know any.
No, well, medical device company is probably more than any one person could invest in to take it over the finish line. Anyways, I've worked on a few of those businesses, and that's an expensive venture. Yeah,
it is. Yeah, that's the thing. But then you get another type of angel, right? The angels where the reason why you want to work with them is not necessarily because they have money, but because they are an expert and they are high, like they themselves maybe made their fortune working in that business. They know everything about that business. They know everyone in that business, in that industry. So the reason why you'd want to work with them is not just to get the money, but to get to tap into their help and them opening doors for you and them giving you pointers and things like this. That's the other reason you would want to connect with these people. And I am a big advocate of that. Like, if you can bring someone in that doesn't just give you money, they give you money and they give you the keys to success with their advice. That's like a double whammy. That's where, to me, it makes a lot of sense. I don't know if you want to speak to any of that.
Well, yeah, and to build on that a bit, Bill, there's the industry experts, which is invaluable because it also shows that someone who's been there, done that, has put their faith in you, and that goes a long way for getting customers. The other type of investor that helpful is someone who says, I've helped scale up companies before and take them from 0 to 60. I see faith in you. I'm going to invest and I'm going to get on board actively to help you with that scale up process. I think as founders, a lot of the time, there's a certain amount of pride that you think you can do it all because we've done it all from the start. We've built this thing from the ground up and that we can just continue to build it up. But those kinds of investors, if you have someone who says, I'm going to help you take this thing into the stratosphere, oh, that is a good feeling. And you want to take that person and throw them as much as they want to take on.
It's great to get that support and that someone believing in you and really feeling like they got your back. They're in your camp. They're on your team, because they're taking a personal risk to help you, basically. It's a great feeling.
Right. And there's a difference there between an active angel investor who wants to help and grow and scale and a VC fund, which all a VC fund cares is about maximizing your revenue and getting a maximum amount on return. So if you're having a VC active, you're getting a little more defined, right? They're there to trim the fat, and they're there to pour gasoline on what's going to make the most amount of money in the quickest amount of time. And it may change your business model, and you might be frustrated with it, but frankly, you don't have much of a choice anymore because you took VC money. And so there's this whole other component to that. So if you're going with someone active, you also need to make sure that you are a good fit with them. Right? There are people who could take your business to the next level who you might butt heads with all the time, and that's not a good place to be.
Yeah, you need to. I mean, in a perfect world, you need to click with them as in terms of personalities, so you work together. So if you're going to take a business decision and you think we should do option A, they don't happen to be another type of person that would think in terms of option B all the time, because that's going to create a bit of friction. People butting heads a lot of times. There's so much good stuff there. First of all, you mentioned VCs, venture capital. And just for everybody, I'm sure most people know this, but for those who don't, venture capital, this is where people invest somebody else's money. So it's run by a fund manager, just like a personal banker almost. They invest their clients' money. They don't invest their own money. They move their clients' money around into different stocks and bonds and whatever, right? So that's kind of what a venture capital is. It's run by a fund manager, and they will invest in many startups. And because the failure rate is something like 90% for startups, if you put your money in 20 startups, 19 will fail, one of them will succeed, and that one that succeeds has to make 20 times the original investment for the whole thing to work, right? So for that reason, like you said, they tend to think purely in financial terms. They're not doing this because they believe in you. They're doing it because they're looking for a good investment. And they don't endemically care about the business. They only care about its ability to make a return on their investment. So that is a different relationship, like you said, from angels, a little bit of a different thing there.
Yeah, and I think there's a cultural component there too that's important to talk about, specifically between Canada and the US, but I'm sure it's different in every country. Is what they're looking for in terms of the scope of the business that you're bringing to them. So, for example, a few months ago, I was talking to a VC fund in the US, and I gave them my 5-year projections, which we all know are made up and bogus anyway. I mean, you'd throw anything there as long as you can justify it. But the answer came back and said, look, we're not really interested. If you're not planning on making 500 million by year 5, just don't talk to us and go away. So here I am, being a nice polite Canadian, where I actually rationalized my figures and wasn't trying to just stand on top of a hill and toot my own trumpet. And they wouldn't talk to me. So there is a cultural difference there, where in Canada, a VC fund might take a look at your forecast and say, that seems realistic. And in the US, it might be a little more, that seems exciting. And that difference is important when you're figuring out who to talk to.
Yeah, they also come in at a much higher level than angels. Angels will be like right at the beginning, right before you've even started. You're just a person with an idea and you're looking for some money. That's where an angel will be able to help you, as opposed to venture capital. First of all, it's like I don't know the exact numbers, and I've been out of tune with this stuff for a few years, but it was like $250,000 is kind of the minimum, right? Like it's kind of that level and up, right? I mean,
probably higher by now.
Probably higher, yeah. Like absolute low end $250,000, probably $500,000, right? Would be like your cutoff. So unless you're thinking in those terms, unless you've thought through all the details and you're going to be spending that kind of money, they won't even talk to you. And then, anybody could say, well, I will take $500,000 if you give it to me. But then the question comes like, well, what have you done? Or do you know what to do with $500,000? Are you responsible enough? Show me a track record where you've been handling that kind of money and you've been entrusted with that amount of money and that amount of people, and then we'll consider you seriously. So it's the bar is much higher for VCs. Usually people start out, the vast majority of people that I think will be watching this YouTube video will be people that are in the angel sort of area, right? Which is, we're talking like 5 digits. That's kind of where you start with that, right?
Absolutely. And those people, just to kind of go back to the previous question that was asked in the chat, it's finding the right relationship there. And maybe it's friends, maybe it's family who know you and have that trust in you. And maybe you get a couple of people together to pool in and get you the amount that you need. But the best thing you can do when you're starting out is just to go and actively try and find people. And go talk to other founders, and go talk, if you have an incubator in your hometown, go talk to them and see if they have any networks. And if they don't want to introduce you to them, show up at their events. Be persistent and don't stop until you find the people you're looking for.
So that would be like because somebody asked, like wherever their question was, they said like, how would you do this? And so specifically, that would be a good recommendation. Showing up at events that are put on by the local startup incubator, or would government events fall into that, or not really? That's not really part of that scene. What would you say?
It depends. I would say you're better served with your time by going to industry associations, things in the startup community. Go check out Meetup in your city and see if there's things going on. There almost always is. Or go, a lot of large tech companies sometimes will host community events or industry associations or anything like that. You go find the room, and maybe it's not investors in that room specifically, right? If you're looking for the investment in a software company, you go to a software event and all you find are other software devs, but they might know someone who knows someone, and that's part of that legwork you need to do. And you're gonna meet a lot of people. Just make sure you keep your thoughts organized when you're doing that. I love spreadsheets. I recommend them for everything. So
just having a good pitch, I guess, right, is the key to be armed with when you go there.
That's the other side too. You need to be able to explain your business in a sentence or less. And then if people say, that sounds interesting, tell me more, you need to have a 30 or 60-second pitch. And then that's all you really need. And then follow up with, I'd love to chat more about this. Can we get a coffee? Name a time and place. I'll be there. Because you want to give them the time. It's just psychologically, it helps when you're just having a one-on-one with them and showing that you're taking them seriously and giving respect. A $3 coffee at Starbucks goes a very long way when it comes to keeping investors happy. Yeah.
Informational interviews are very important to do. A lot of people don't know what those are. They've never done them. They don't know they exist, and they wouldn't know how to initiate one. So it might be worth maybe in a future chat getting into how to do that. What I think is interesting, and you are a living testament to this, is like this topic. This is a financial topic. Now, when you think finance, you think like accountant, you think financial manager, you think somebody sitting at a desk, working on the computer, working at a desk, being very introverted. But the way to sort of get the ball rolling with this stuff in the beginning is the opposite of that. It's marketing, it's networking, it's going to events and striking up a conversation with people you see at the events, presenting yourself well, being able to answer questions, and then following up with the ability to do an informational interview afterwards. I mean, that is sales and marketing type activity, but it's necessary in this context where we're talking about finance and accounting, right?
Absolutely. Yeah. And with that network, as a CEO or founder or whatever the case might be, you are the brand and you are the company. So it's important to practice this because they will be judging you on the merits of how you speak and what you're saying more than any other supporting documents that you could provide. So make sure you understand what that means, right? How to show up and present yourself, body language, a way to introduce yourself to different people, how to get introduced by others to people you want to talk to. It's an art, and you need to make it a priority. And go ahead.
And the fact that you're going to events, it's very extroverted, very sort of outgoing type activity. I mean, this is not, I think, what a lot of people. It's not what leaps to mind when people think of raising capital, getting money together. People, I think, have this idea of, okay, I need to go to a bank and talk to a banker, or I need to stay at home and fill in online applications for, like we talked about earlier, for, government programs and loans and grants and things like this. So it's a little bit of a gear shift. People don't see this as the way to get money, but actually this is how you do it, at least at the angel level in the beginning. I've always thought that that's quite ironic.
Mm-hmm. Yeah, it's going and then pounding the pavements, and you could do outreach on LinkedIn and all of that, and it's all valuable for sure. But nothing beats a face-to-face conversation, especially because you're trying to sell yourself, and there's no better way to do it.
Yeah. And and that's you just brought it up again, that whole like trust in the entrepreneur thing. That's another thing that I think a lot of people don't understand. Okay, the conventional wisdom for how do you get an investor, right? How do you convince a room full of investors that they should invest in you? And a lot of universities and stuff, business schools, they put on the pitch competitions, and they have all those going, like they have pitch competitions for high school students, and they have pitch competitions for universities like business schools, and then they have public pitch competitions, and then they have the real thing, like a private kind of pitch competition, right? Life is a pitch competition in a way, and what I've seen over and over is that people have this belief that, okay, if I want to convince an investor to invest their money with me, I talk all about the product, or I talk all about this technology that's coming in, and that may be a part of it. But the big question that the investor is thinking is not whether this technology is going to be big or this product is going to succeed. The question is, does the investor believe that you as a person are talented enough to pull it off and make it a success? Like, so you're selling yourself, you're selling your ability to do it. And that's the most critical factor. And it seems to be under the radar for a lot of people.
You know what I look for when I'm looking at pitches in a competition format is how they stand up under the Q&A portion. Because anyone can memorize a script, right? I can go up and have my deck and I know when to flip it, I know what words to say, and that's all good. But if it all starts unraveling and you start getting defensive when people start asking you questions, that to me is a bigger sign than anything else that you said in the presentation. A good founder needs to believe in the company. They need to be knowledgeable about it on very short notice. So if someone asks you a question, you have to have an answer right away, but you also need to be professional. And it's a hard thing to do because it's your baby and you've been working on it for a long time. Then someone says, why are you doing it this way? That makes no sense. And you need to keep composure during that. And a lot of times, maybe they might not even think that the person who asked that question, they're just trying to test you to see what your answer might be. And so not taking things personally and making sure you're answering in the right way, huge for attracting investors.
Yeah, and that's I would have problems with that. I've had problems with that, you know, and I know exactly what you're saying. Some people, they ask you borderline insulting questions, and you have to, like, as you say, maintain your composure. The other thing is that they, as you said, I've fallen, I remember years ago, I've fallen victim to that, where they don't honestly believe what they're saying. Like when they say, like, why are you doing that? That makes no sense. You know, why wouldn't you do it this way? People want this other thing, not that. You know, they don't actually believe that. They're doing it as a test just to see your reaction. And I've been in that. I've seen that firsthand. And then you find out later, like, oh, okay, you don't actually think that. You're just throwing that out as a for instance. You know, I thought I had to, like, convert you and, you know, dispel this ignorance or this this different attitude. But no, these are all skills that you need in the financing side. And I just want to come back to that whole thing where intuitively you don't think this is what getting access to financing is about. It's a very salesy, marketing, networky type thing. And preparation is the key, and knowledge about what you're doing is the key. Because if you really don't understand what it is that you're proposing, you've never worked in it, you've never seen it, you haven't lived it and breathed it, that's gonna show pretty quickly, like, as you say, on the Q&A sessions. So no, that makes perfect sense. Someone says, if you did accept money from an investor, do they have pseudo partner rights? Can they veto your ideas or directions? Would you like to take that?
Sometimes. So what you'll want to do before taking investor money is prepare something called a term sheet. Ask your lawyer. And that is just kind of setting up terms for what that agreement looks like. And the other thing that you'll want is to have your shareholder agreement that gives rights and obligations to each shareholder. Again, your lawyer can help with that. Don't try and write one yourself. It is protection. It is the best insurance you could ever have if you're taking external money. And so the terms there will matter hugely. If you're giving majority control, if an investor is coming in and taking 51% of your company, congratulations, it's not your company anymore. Now you work for them. And they get to make all the decisions, unless there's some things that like need 2/3 vote or something that's in your shareholder agreement. So you need to be careful. So when you're trying to look for investments, the whole thing is a negotiation, especially when you're at the angel level or just starting off. So a business will have a price tag set for it. That's much it's valued at, its valuation. And you can pay someone to do that for you. But for the most part, your first valuation as a startup is whatever someone's willing to pay for some percentage of it. So if someone wants to give me $10 million for 50% of my company, then my company's worth $20 million, right? Just 50% times 2. Simple. Yeah. So what you're trying to do in taking investor money is get as much money as you possibly can for as small a percentage as you possibly can, because that protects your interests. And what the investor will try to do is give you as little money as possible for the highest percentage. So you go back and forth on this, and the implications there are exactly to answer that question: who's going to be controlling? How much say do they have? Can they overrule you? So make sure, right, in preparation, as Bill, you were saying, it's important to prepare beforehand. Know what it is that you're giving away.
Yeah, that's great advice. First of all, you're absolutely right. Term sheets, don't try and write it yourself. To write a term sheet, you not only need to be a lawyer and understand the legalese of contract law, but you also need to understand corporate finance. You have to understand, company structure and shares and options and, and some of the dimensions to doing these different deals. So it's very complicated. But I personally feel that if you're going to get into this, it is worth investing in yourself and learning it. So if you don't have a background in corporate finance, it's as simple as skimming one textbook on corporate finance and like really wanting to learn it. Because this is going to be everything to you. If you get into a bad shareholder agreement, or you have a bad agreement with an investor that, like, as you say, you've signed your life away and you're not aware of it because they've got you on some of these loopholes that you weren't aware of. That's obviously very significant. That's, you've just either lost your control of your company, or you've just guaranteed that you will never make any money at this, So being unaware of that is a very bad thing, right? So, so if you're going to get into that, I would say, immediately go to, a university or something, get a textbook on corporate finance, find out what textbook they're using in their market, their corporate finance course for like their MBA program or something. And then just buy the book and maybe a 400-page book, but, maybe not read it, but skim it. You can do that in like 2 weeks. You can become totally versed in all this stuff. And at least if you might not be an absolute expert, but you at least know enough to avoid the major pitfalls, of these things, and understand what these words are and all that. And like you said, it's a negotiation, and the negotiation comes down to trust. If Steve Jobs or Bill Gates approached you and you had money and said, would you like to invest in my next venture? I'm going to do this thing, it's going to be, and then they rattle off some technology you don't understand and a market you don't understand, but it's Steve Jobs or it's Bill Gates. And I mean, you look at their track record, you're probably going to think, you know what? I don't understand it really that much, but I believe that you know what you're talking about. And for that reason, I will invest. The last company you started made, billions and billions. So I think it's a justifiable risk to do this. So it comes down to trust. So during those negotiations, if they really don't trust you, it's not going to go well. If they do trust you, then there's potential for some kind of harmonious partnership, right? I mean, I really, all the complicated legal stuff and the term sheets, it just comes down to trust. Do they trust you? And do you trust that they believe in you? I think that's the most important thing.
Absolutely. Absolutely.
Let's see here. There's so many parts to this. There was something, I don't know if you wanted to touch on this, but something called the Valley of Death. I think that's an important topic. Would you?
We're going to book. I have it right here.
Yeah, there's been many books written about this, but this is a very important concept for lots of startup founders or would-be entrepreneurs to know about. Okay, the Valley of Death.
I lent this copy of my book, this copy of my book, to everyone because I always recommend it. But it's called Crossing the Chasm by Jeffrey Moore, and it's a book that I think every founder should read. It is essential, as far as I'm concerned, in understanding what you need to do and who you need to talk to at what time to survive the commercialization pain points of a startup. There will be a time when you are burning money and you're not making enough money yet, and that's why they will call it the pit of despair or the valley of death or whatever you might want to call it. There's different names for it, but finding your way out of that is the hardest thing for a founder to do. So just can't recommend that book highly enough. You can read it in less than a week. It's nice plain language stuff. And it will help you, I think, really understand what you need to do and how you need to present yourself and sell yourself to investors as well.
Yeah, I will put a link in the description to the book, in whatever form I find it. Yeah, Valley of Death. It's and I mean, I did read that book. It was a few years ago, but it's basically the idea that when you're first starting out, there are sources of financing available to you. There are usually in the form of government programs. They're willing to invest money in people just starting out. You want to develop an idea, right? Well, there's programs and there's resources for people at that stage. And then once you've launched your business and you have customers and you're starting to make money, at that point, there's a lot of financing options. Banks will want to lend to you because you're making money. All of a sudden, now once money starts coming in and you're showing that you're a success, then everybody wants to lend you money, right? So you have a lot of options there. But between those two steps, the idea stage, I don't know what I want to do, to, oh, I'm a success. In between those two stages, there's nothing. There's practically nothing available. So that's what they call it, the valley of death. So the challenge is making it through that stage. I keep bumping my mic. Through that stage where you've got your idea, you've gotten some startup money to get you on your way, but now you have to produce something and you have to start selling it. And all during that time, you have no help available financially. So it's an exercise in conserving your money, your resources, and making accurate predictions about, what's going to happen and the timeline, right? And that's the challenge that most businesses face.
Yeah, and there's a lot of work that you need to do into minimizing that burn. So what you need to figure out are your monthly expenses, and then try to reduce that number for as long as you can, and stretch the dollars you have for as far as you can. And then you work back from that and say, okay, I have 5 months before the money runs out, which means that I need to have something that's ready to sell at the latest in 4 months. How do I get there? And that's it. That is now your job, is to meet that 4 month deadline so that you make it before the money runs out. And to get through the valley of death, it is a race against zero. You're running from the overdraft in your bank, basically. And that's it. Everything, every decision you make has to be based on that.
And I remember when I was working with a lot of startups, it's like you would see people get grant money or they get loans, and they'd be renting office space, like leasing office space. They'd be buying computers. They'd be doing, and I remember, and I remember thinking like, oh my God, that you need to be much more frugal, much more judicious in where you use this money, because people get money and they think, oh, okay, this is how it works. The money just rolls right in, and I got lots of time here to get this thing off the ground. And the reality is, no, after that initial funding that they get nothing, and they soon run out of money, and then the whole thing fails. They never get to the point where they launch and they get customers and they start making their own revenue. So that's probably the number one reason why entrepreneurial type ventures fail, in my experience. I don't know what would be the number one reason people don't get money, or they fail, they don't get enough money? What would you say?
I think the number one reason is they're trying too hard to make something perfect. This is a very Canadian trait, and I'm guilty of it myself. Where you want something to just be as good as it can possibly be before anyone sees it, because it's your baby and you've worked hard at this and you want it to function as well as it can. But your money's going to burn that way. You're going to run out of cash, and because you haven't talked to any customers by the time that the crunch shows up and you're out of money in your bank account, you haven't established those connections and you haven't done any marketing to make sure that that you have something that's ready to sell. Something that's operating at 80% functionality, or, be bold. If something that's, as long as it works and turns on and does what it's supposed to do, just go and try with that and then make it better. Because there's a lot of founders that I know who have tried for perfection, and that has just led to their demise.
Yeah. Great advice. So some key takeaways then, coming back to the initial topic of startup funding. What are some of the key takeaways here? I would say, number one, look into government programs. Usually at every level of government, they'll have their own entities set up that give grants and give loans to either entrepreneurship type things, innovative entrepreneurship, or small business loans, things like this, more traditional, not necessarily innovative type companies, traditional companies. There'll be all kinds of programs set up. Investigate those. Once you do 5 of those applications, I think, you can see the pattern. They all tend to go the same way. Then to check out angels, what would be your recommendation for that? Just to sum up, we talked about angels.
Prepare in advance. Make sure you know what you're saying. Make sure you know how to talk to people and present, and then go out and work the room and work every room that you can possibly find. Set aside your evenings and weekends to go and do this. And your goal in those is to get one-on-one meetings, to have further conversations with these people.
Yeah. And if you're not a super like networking expert, extrovert type person, what might help is just think about it in terms of you're going to go to an event, you're going to hopefully enjoy it. You're going to talk business with people. It'll be enjoyable. You'll get some ideas. Think of it that way. And rather than this very forced kind of thing, I'm out to get investors and, okay, so think about it that way. Brush up on networking, but brush up on sales and marketing and do your preparation. Like you said, very important. And then we talked about the valley of death. Takeaways from that is that if you do get money at the beginning from government programs or elsewhere, learn to be frugal. I know this is a cliche, but it's true. Learn to really save that money and only use it when absolutely necessary, because you're going to go through the valley of death. There's not going to be more money for a while. You can assume that to be true.
Absolutely.
What else is part of that? Like the other thing, and maybe this is getting away from funding, but it sort of relates to it. It's if you can really go back to your business plan, and I say this so much, but if you can really go back to your business plan and think, is there a way that I could shorten my path to the point where I make money? Can I tweak my idea? I don't know if you speak to that.
You're trying to build something as a founder that you think people want to buy. So go and find that thing that people want to buy and sell it to them. And it sounds kind of ridiculous to say, but I think that we have a tendency as humans to just want to overcomplicate everything more than it should be. If there's someone who's willing today to give you money for something that you have built, that is all the validation you need. And if you make that sale, it makes it easier to get more sales. It makes it easier to get investors. It makes it easier to get more debt financing. And the sooner you get to that point, the sooner you get out of the valley of death, the better off that your company is going to be.
Yeah, exactly. I mean, I've since thought of an example just in the last 10 seconds to illustrate what I was saying earlier about shortening the path to being revenue positive. For example, if you want to start a restaurant, you want to start a pizza place, right? And you're thinking in your head, like you were saying, we are perfectionists. We think of the prize. We think of us having our own restaurant. We make pizzas, we sell pizzas. People come in and sit down and they eat, and it's a success. And that's what we've got in our heads. That's why we started our business. But if you're thinking, okay, how can I get to making money sooner without spending all of that to create this restaurant? You can think, okay, maybe I don't need a restaurant. I could have a delivery service. So a delivery service, you just need to produce the food and then have like a driver or whatever. You wouldn't need to pay for the full-blown restaurant and all the tables and the atmosphere, blah, blah, blah. So, okay, if you eliminate that expense, could you get money coming in sooner if you eliminated the restaurant? Then, if we eliminate the whole driver kind of order-taking system, but we're making pizzas, can we sell our pizzas frozen to, a local supermarket or something? So, okay, we don't have the delivery, we don't have the restaurant, but we have the pizza making entity set up. So that's 1/3 of what we'd have had to pay for before we see a revenue. So the problem is, like you said, we're perfectionists. People think, no, I don't want to do that. I want to do a restaurant. That's why I want to do this. And what I find is that, if you say to people, look, like, can you think of those so that you will get to your restaurant? But let's call that phase 3. Phase 1 is just making pizzas and selling them to a place that sells frozen pizzas. Can you do that as an intermediate step so that you self-fund your journey to the restaurant, and then you need less financing, and then you try and make it through the valley of death. The valley of death is a lot shorter for you in that situation. So it's things like that. And I found that a lot of people, they don't even think like that. If they thought like that, there would be stuff they could do to shorten that valley of death that they have to get through. And that reframes your whole attitude towards financing. You don't need as much, and you will make more money because you are self-financing the later stages of it. So this is all part of the topic. It's a huge topic. Is there anything else you'd like to that you feel is part of this that you want to bring up before we wrap?
I think just don't sell your soul to credit card companies. Don't mortgage your house. as a founder, you will probably end up putting some money into this, and it's probably going to be more money than you wanted to. But make sure that you're not taking any unnecessary risks. Of course, it's a gamble. Nothing's a bigger gamble than founding a startup. But if you're going to potentially be hurting yourself for 10, 20 years down the road, see if there's another option out there that might make more sense. Sometimes the easiest answer is not the best one.
Yeah, that's great. That's great advice. That's a great way to frame it. So excellent. Well, thank you, Matt. That's been, I think, a great chat. I think we've scratched the surface of this topic. This is a huge topic. You could go so many different directions. Yeah. So I think we should do another one of these in the future. Hopefully we'll get a chance to if you're up for it. I think it was great. I really appreciated some of the stuff you said. And I think that the topic that you brought up about getting angels and the networking stuff, I think I suspect a lot of people would be interested in hearing you in particular go deeper into that and maybe share some of your experiences. So that's hopefully something we could do in the future.
That sounds good to me.
Awesome. If anyone wants to contact you, can you, do you have you gave, I think, an email address, if you want to repeat that, and if there's any other way to check out your stuff?
Sure. It's matt@ioAirFlow.com. You can check out our website, ioAirFlow.com, or you can always reach out to me on LinkedIn under Matt Schaubroeck. Should be easy to find, even if you can't spell the name too easily, but that should be in the bio for this video.
Awesome. Excellent. Okay, thanks everyone for joining us today, and thanks, Matt. And we will. I would very much like to do another one of these, so hopefully in a week or two we'll have that opportunity.
Sounds good.
Awesome. Okay, thank you, everyone. Have stay safe and have a great day.